Hello dear students, welcome back. Today we are going to do question number 14 of your textbook. So here is the question. Chirag, Jigar and Keshav are the partners sharing profit and loss in the ratio of 3:2:1. The firm's old balance sheet is given and here retiring partner is Keshav. Keshav retired on 31st March 2016 and some conditions are given. So let's start. Here we have to prepare revaluation account, partners capital account, cash account and new balance sheet as on 1st April 2016 after retirement. So let's start with the first point. Here in the first point it is given that value of land and building is to be increased by 20%. Here 20% of 50,000 is 10,000. 50,000 is the value of land and building which is shown in their old balance sheet. So as here value of asset is increasing, so we will record it on credit side of revaluation account. Here it is by land and building amount 10,000. Then its second effect will be given in balance sheet. Here it is. We will add rupees 10,000 as here the value of land and building is increasing by 10,000. So in outer column we will get 60,000. Here it is. Then next point, machinery is valued at 90% of its book value. As here value of machinery is decreasing, so we will deduct it. Here we will deduct 2,000 and in outer column we will write 18,000. And in revaluation account we will record it on debit side as the value of asset is decreasing. Here it is to machinery account 2,000. Now third point, market value of investment is 150% of its book value. So let's give effect of this. Here as the value of investment is increasing, so we will record it on credit side of revaluation account. By investment account 5,000, it is increasing by rupees 5,000. And in balance sheet here we will add 5,000 to the amount of investment. Here it is 5,000 as the value of investment is increasing by rupees 5,000. So in outer column we will get 15,000 which is market value. Then next point, point number 4, bad debt reserve on debtors is to be reduced by 5%. In the old balance sheet, debtors is shown at rupees 20,000 in the inner column. So 5% of 20,000 is 1,000. That is our new value of bad debt reserve. So we will deduct 1,000 from 20,000. So we will get 19,000 as new amount of debtors. Then as it is kind of profit for the firm, so we will record it on credit side amount 1,000 by bad debt reserve. Here it is. As in the old balance sheet, bad debt reserve is shown at rupees 2,000 and our new value of bad debt reserve is 1,000. That means here bad debt reserve is decreasing by rupees 1,000. So it's a kind of profit. So we will record it on credit side of revaluation account. Then next point, point number 5th. Goodwill of the firm is valued at rupees 36,000. Here firm's goodwill is given which is 36,000. So let us find out retiring partner's share in goodwill. So it will be found out by multiplying 36,000 with retiring partner's share in profit. Here retiring partner's share in profit is 1/6 according to the old ratio, that is 3:2:1. So retiring partner, that is Keshav's share in profit is 1/6. So 36,000 multiplied by 1/6, we will get 6,000. So 6,000 is the amount which is receivable by retiring partner, which will be compensated by continuing partner in their gaining ratio, and here the gaining ratio of continuing partner would be 3:2, which is same as their relative old ratio, because here no other informations are given, like here no information is given regarding new profit and loss sharing ratio, and no information is given regarding gaining ratio. Here only old profit and loss sharing ratio is given, so in that case we will consider gaining ratio as their old, as the same as their old profit and loss relative profit and loss sharing ratio, which is 3:2. So according to that ratio, here Keshav will give 3600 to retiring partner. Here it is, and Jigar will give 2400 to retiring partner Keshav. Now next point, point number 6. Rupees 2000 is outstanding for salary payable to an employee. Here outstanding salary is unrecorded liability here. So when unrecorded liability is brought in the books, it is a loss for the firm. So it will be recorded on debit side of revaluation account to outstanding salary account, amount 2000. And in balance sheet, we will show it in liability side. Here it is, outstanding salary amount 2000. Then next point, point 7. Chirag and Jigar will bring necessary amount in cash in such a manner that amount due to Keshav is to be paid in cash, and balance of cash may remain in the firm as working capital rupees 14,000, and their capital in the new firm become proportionate to their new profit and loss sharing ratio. So here working capital is given, that is rupees 14,000. It is given that balance of cash may remain in the firm as working capital rupees 14,000. That means it is closing cash balance. Here closing cash balance is given, so we will show it on asset side in balance sheet. Here it is, cash 14,000, and we will show it on credit side of cash account also, as it is closing balance of cash. Here it is, by balance carried forward 14,000. Now remaining items from their old balance sheet will be recorded. Here we will record opening capital balance, that is 30,000 of Chirag, 20,000 of Jigar, and 10,000 of Keshav. Then general reserve will be distributed among all partners in their old profit and loss sharing ratio, which will be 3,000, 2,000, and 1,000. Then creditor will be recorded. It will be shown on liability side. Here it is, creditors 44,000. Then land and building we have recorded, machinery we have recorded, investment already recorded, then stock we have recorded, debtors we have recorded. Now opening cash balance will be recorded on debit side of cash account, that is 2000. Now we will close revaluation account, and here we will get revaluation profit, that is rupees 12,000, which will be distributed among all partners in their old profit and loss sharing ratio. So here 6,000 will be distributed to Chirag, 4,000 to Jigar, and 2,000 to Keshav, which will be transferred to partners capital account. On credit side, here it is 6,000, 4,000, and 2,000 revaluation profit. Now let us read the last point once again. Point number 7. Chirag and Jigar will bring necessary amount in cash in such a manner that amount due to Keshav is to be paid in cash and balance of cash may remain in the firm as working capital rupees 14,000 and their capital in the new firm will become proportionate to their new profit and loss sharing ratio. So here first we will close retiring partner's capital account in order to find out uh, the amount due to him which is to be paid in cash. So here if we close Keshav's capital account, we will find difference on debit side, that is rupees 19,000, which is the amount due to Keshav which will be paid in cash. Now as it will be paid in cash, that means our cash balance will reduce. So in cash account we will record it on credit side. Here it is by Keshav's capital account 19,000. Now we will find out total capital in new firm. In order to find out new capital of Chirag and new capital of Jigar. So we will find out total capital in new firm by adding balance of capital accounts of Chirag and Jigar after all adjustments. That comes to 35,400 of Chirag and 23,600 of Jigar. If we add these, we will get 59,000. 59,000 is balance of capital accounts of Chirag and Jigar after all adjustments. Then we will add shortage of cash to be brought in order to make payment to Keshav. That comes to 31,000. You can get 31,000. That is the balance of cash account. If you see in cash account, by now we have recorded amount payable to Keshav, that is 19,000, then working capital, that is 14,000 on credit side, and opening cash balance, that is 2,000 on debit side. If you add amount payable to Keshav, that is 19,000, and working capital, that is 14,000, and then subtract opening cash balance, that is 2,000, you will get 31,000 as shortage of cash to be brought in order to make payment to Keshav. Then if we add 59,000 and 31,000, we will get 90,000. 90,000 is total capital in new firm, which will be distributed to continuing partner Chirag and Jigar in new profit and loss sharing ratio, as it is given in the question that their capital in the new firm should become proportionate to their new profit and loss sharing ratio. And here new profit and loss sharing ratio is 3:2. So according to that, here new capital of Chirag would be 54,000 and new capital of Jigar would be 36,000. So let us give effect of those in partner's capital account. Here it will be recorded on debit side as it is new capital of Chirag and Jigar. Here it is. We will write 54,000 in Chirag's column and 36,000 in Jigar column to balance carried forward. Then its second effect will be shown in balance sheet. Here it is. Capital accounts Chirag 54,000, Jigar 36,000, and in outer column we will write total, that is 90,000. Now we will close continuing partners capital account. So first let us close Chirag's capital account. If you close it, you will find difference on credit side, that is 18,600. That means here Chirag has brought rupees 18,600. And if you close Jigar's capital account, you will find difference on credit side again 12,400. That means Jigar has brought 12,400 in cash. And as these are the amounts which are brought by continuing partner in cash, that means here our firm's cash balance will increase. So these amount will be recorded on debit side of cash account. Here it is to Chirag's capital account 18,600 and to Jigar's capital account 12,400. Now here your balance sheet will be tallied with the amount 1,36,000. So that's all for today. Here we have completed question number 14. Thank you very much.